All right, and we're live. Thank you all for joining us on this day two of professional tape reading strategies. We are getting to brass tacks, as uh, Saul Goodman would say, and we're going to dive right in to auction market theory, and then go over the basics of volume profiling. For a lot of you who employ volume profiling, this is going to be the first part's going to be a quick review. A lot of you guys are novices, so we're going to get into it. And then we're going to get into the advanced rules of volume profiling, the extensions of volume profiling, and so on and so forth. This is the fundament. The most important part of tape reading is understanding the places where tape reading is actually important. Understanding those supply zones and demand zones and rotations and so on and so forth, right? So the tape reading is going to be the when. This is the today is the why and the where. So today really is all about understanding what those key inflection points are, mapping them correctly, and when we jump into the footprinting and time and sales section of this course, you're going to understand how to actually read that real time tape once you understand the inflection point, the demand zone, the supply zone, the volume gap, etc., whatever it is, so that you can actually execute. Okay, so that is where we are right now in terms of this journey together, this never ending journey. Okay, so let's go ahead and jump right in. My volume is good, right? You guys can hear me okay, Monica? Because recording is forever. Okay. All right, let's go ahead and get started. So, what is auction market theory? So, it was created by Peter Steinmeier and popularized by Jim Dalton. There's a lot of you guys who are fans of the market profile, and so you're familiar with some of these names and terms. So, auction theory breaks down the market's primary purpose and how market participants interact who fulfill this purpose. Oh, there's a little typo there. Facilitate trade in two-way auction process. Seek fair value of the asset. Market profile represents value area and point of control on time. Volume profile represents the value area and point of control based on volume. So let's digest some of these ideas. So why have a theory of the auction? That is the first question people ask me. Like, Jared, why is this even important? What, like, who cares about an economist and a mathematician who got together, and then all these academics who came up with this theory? Like, how does this even remotely apply to what we do in the market every day? Well, the auction theory is important because it really breaks down your daily interactions in the market. It labels them and it explains away, in my opinion, in a very effective manner, why the market behaves the way it does. Okay, so that is really the real crux of it. The market is a pricing mechanism, right? And it's always seeking what we call fair value, right? Fair value for sellers may be a place where their ideal selling point would be. Fair value for buyers, or be where buyers are interested in transacting, and ultimately we're looking to profile those transactions. Okay, the market profile represents the value area and point of control on time, right? So market profile will slice the market in terms of volume and then time periods, which is also super helpful and I use a lot. Today we're going to be focusing on volume profile, okay, which represents the value area and point of control based on volume, okay? So we're going to be looking at volume at price today. So order flow and why markets are moving. Next is this is an important concept. A lot of people don't think about this. This is pretty obvious, right? But limit orders are really advertisements, right? When you put a limit order out, what you're doing is you're telling buyers and sellers what you're willing to pay, right? And you're providing liquidity for the market. How many of you guys get liquidity rebates through your platforms? How many of you guys, get money back for offering liquidity to the market, right? Well, why are you getting rebates? Why do you think the market is paying you guys to provide liquidity? Right. Because you're a market maker versus a market taker. You're facilitating the transactional fluidity of the market, right? And there is a premium paid for that. So market orders are obviously executed against limit orders. They are they're an impatient way to enter the market, okay? And you are taking liquidity. You are taking liquidity from the market, right? So this is just a quick picture of a dome, right? So a depth of market order system, and you can see here you've got your volume profile on the left, right? You've got your volume profile on the left here. You've got your price ladder right here, and then your limit orders are your advertised prices, right? Here you see labeled executions on the bid versus the offer, so that's your volume delta, okay? And here's like a lot of these domes have change in order, so you can actually see in a lot of these how these orders are changing as prices fluctuate, right? So we often talk about fair value within a Gaussian distribution curve, right? And typically, 68% of price within fair value stays within that one standard deviation, right? And then when you go two standard deviations out, that covers like 95%. And then the third standard deviation from the mean, right, covers 99.7% of all price action as far as the mean is concerned. Okay, so key concepts. Okay, price advertises opportunity in the market. Okay, so meaning this is a key Jim Dalton concept, right? So you see a price, it's an advertisement for an opportunity, right? Sometimes we'll explore how the profile actually will analyze prices that are unfavorable through volume gaps and such, right? And then time regulates that opportunity, right? Through the through the x-axis, and then we've got volume, and that is the measure of success or failure of a particular auction, right? And that's where we get into your points of controls, your B-shaped profiles, your D-shaped profiles, your high volume nodes, your low volume nodes, and what they mean. What platform is that dome? I believe that's ATAS. Dr. Divergence. Is that Wilson Chase? It's got to be Wilson Chase. Couldn't be anybody else. I know. It isn't. Who's Dr. Divergence today? Not me, boss. Wow. Okay. We have a mystery attendee. All right. So in terms of market auction theory, right, you talk about balance or imbalance. And I did an entire course called Momentum Mastery Volume 1, where what we literally explored, right, was how momentum is created, right? And the entire theme of that course is that when you have deep imbalances in demand and supply, right, you end up experiencing strong thrusts in either direction of that imbalance in order to satisfy that imbalance and come back into into balance, right? The market always seeks balance, right? When it's overpriced, it corrects. When it's underpriced, it corrects, and so on and so forth. So in balanced markets, buyers and sellers agree on prices, and they're willing to sell for current prices. These prices are considered to be fair value. Once there is a new price, a piece of information coming into the markets, either technical or fundamental, market shift toward imbalance, right? So, for example, what would be an obvious example of a deep imbalance in the market? News, okay, exactly. Is this market perhaps struggling with finding balance, John K, these days? Is it perhaps repricing? Are we perhaps repricing uh, what the news means and what our future is every 5 to 10 minutes in the market? Absolutely, right. So a lot of fundamental, shifts, right, can create imbalances. What are some technical shifts that could create imbalances, guys? What are some technical shifts that could create imbalance? Okay, gamma exposure, excellent. What else, guys? What do you think? Okay, Jackson Buicks, options expirations, short covering. Exactly. These are all technical catalysts, right? We don't just have fundamental catalysts slapping the market around every day. We also have technical ones, right? So imbalances, right, ultimately present disagreements in fair value, right? Buyers and sellers um, disagree on fair value. Okay, one side of the market participants is more aggressive, which causes the trend to change. If for example, um, China announces that it's going to have a massive backlogs and won't be able to ship iPhones for the next 4 months. What do you think is going to happen to the price of iPhones? Is it going to go up or down? Not a trick question. It's going to go up massively, right? You're going to have a supply demand imbalance, right? General markets only tend in general markets, and we're talking about short term here, only trend 20% of the time. Once markets are in balance, they often go higher or lower until stops, usually inside the previous area of balance. So markets like to travail ranges, and when they are imbalanced, they will go higher or lower until they find a prior memory address, right, where you had a prior area of balance where there was agreement between buyers and sellers as to what the correct price should be. How many times, guys, do we see, a stock we trade, you know, visit areas of balance and imbalance, like in a very familiar way. Like, you'll have one balance range, right? An imbalance and a two-wave corrective, and you'll be here, right? And then something happens, and the market will go right back to trading at that other prior area of perceived value where, buyers and sellers were both in agreement that this was fair value, right? Happens all the time. Look at Tesla, for example. Tesla will go from, trading the 220s to trading the 250s to trading the 220s again to trading the 250s, right? And it goes back and forth until it breaks out. Those are magnets, absolute magnets. Especially Wilson Chase, as we'll discuss later, because there's so much prior transacted value in those ranges, right? So that's a really, really important concept because a lot of the work we do is to map those zones, and they're recognizable easily through technical analysis, and they're really good reference points for finding like prior maps of value. A lot of times, guys, We a lot of days where on a big stock like Netflix or Tesla, right, we'll be 20 cents away from target on an 18-point move or 17-point move, or we'll be $1 off or whatever. How are we so accurate? Well, it's because we watch the footprints of the auction, right? And we remember what those areas of fair value have been in the past, right? So, um, is it also called filling the gaps? Well, Gurpreet, the filling the gaps, the filling the gaps price action theory is the direct uh, is the is the direct result of this phenomenon, right? So it's how price manifests. Absolutely, okay. It's how imbalances become balanced again, many times. Not always, but many times. So response initiative activity. So this is an important concept for you to just understand and keep in the back of your mind as you're watching the auction, right? Responsive activity is is action that usually is responsive to a prior action, right? So when the market dips into value area low in a range, right, you can expect responsive activity. Why are buyers buying responsively at value area low in, let's say, like a D-shaped profile? Why are they doing that? Anyone? Support is there, but why is support there? Because it's perceived as an area of fair value in terms of price, right? Buyers find that to be a good price, right? So back to say, uh, oh my God, this problem again. So, say we have a major DRAM problem, right, in the market, and DRAM is really expensive, and the glass for iPhones is really expensive, right? So the market, say, for an iPhone 15 within this range, right? This is 900 and this is 800, right? Buyers find it a good value to buy an iPhone 15 at $800. Sellers, right, like to sell at 900. So say the DRAM issues intensify, right? So you have scarcity, all right, and the auction will move to where the lowest you'll be able to get an iPhone is $1,000, and sellers really want to get their offers taken at 1,200, right? Well, as often happens when the prices come lower, they'll revisit that prior value area, right? But the responsive buying will occur at 800 as prices come down, right? So responsive activity is often seen as sharp low liquid moves. So it's pretty self-explanatory. Initiative activity. So initiative activity is unexpected behavior, right? When the market breaks below value, selling is unexpected. When the market breaks above value, buying is unexpected, right? Meaning, like, what do we say happens 80% of the time when price tries to take value area high out within a balanced profile? Within a balanced market, right, 80% of the time, price will rotate within that value area, right, between value area high and value area low, right? So our two areas of fair price, depending on whether you talk about buyers or sellers. So initiative activity happens when buyers take initiative and really push that price above value area high, and when sellers really push that price below a value area low. And we're going to talk about more about initiative activity when we get into the footprinting and order flow analysis part of this course. But the idea here is that there's really two types of initiative. there's two types of activity. You know, which is more likely to say, for example, use market orders, responsive or initiative activity? Exactly. Okay. When market only occurs when the environment shifts. It's primarily true. So the other concepts that are important, right, that we're going to keep using. This is why I'm bringing these up. Acceptance. So prices are accepted inside of fair value or a break outside. Market participants agree on new prices, and we can expect continuation of price. You know, all day long, you'll hear me say, I like, XYZ. I like Moderna if it breaks above 30 and holds, right? What I'm really talking about is a price acceptance over 30. Why is that important? It means that the auction has shifted higher, and there's a good chance that if that is happening, that prices may continue to take higher, and we go from a responsive to initiative markets. Right? Does that make sense? A failed auction, it's a term we've already discussed informally in the room, right? Failed auction occurs when price comes outside of the value and it does not gain acceptance. Okay, so oftentimes you'll have, a markup, a breakout with the three legs higher, right? And you'll have a reaccumulative demand zone here. And all of a sudden it breaks below and it's unable to auction at the prior value area low, and gives you maybe an inverse head and shoulders, and then to a corrective, and continues to auction here and higher. Right. Very common failed auctions intraday are, for example, end of day liquidation breaks, which are bear traps. Right. They'll shake you out with one or two candles, and then they'll bounce right back and continue to flag into the close on really, really bullish days. Right. Is that also considered a break and retest? What I'm drawing here. Yeah, the thing of a failed auction is essentially the market's inability to auction at the prior value area, right? If price drops and there's a demand and supply imbalance, and they drive the price right back to the initial balance range, then you have a failed auction, and you failed to auction to the prior lower level. Okay. So next, the 5 rules. So if price accepts into balance area, it is likely to revert to the other side, right? So if price accepts into balance area, is likely to revert to the other side. So we're talking about the fluctuation, right? Oh my God, this is freaking killing me. Sorry, guys. So you have a value area high and low, right? So you're gonna likely be doing this a whole lot, right? Price often retests the edge of the balance area before traveling to the opposite side, right? That's what makes the profiles of balance ranges usually D-shaped, right? You're going to be doing the most transaction through the middle, and you're going to be transacting to top of value and bottom of value, where buyers and sellers find equilibrium by buying the bottoms and selling the tops. Price inside a balance is expected to reject the edges and is choppier. Okay, so that's pretty pretty self-explanatory. Once price accepts outside of the balance, it is likely to become imbalanced and seek new value. Well, what is the mechanism for that happening? Like, we understand the concept, right? Once price accepts outside the balance, it is unlikely to become imbalanced and seek new value. Well, what causes that? The search for what? What is the market looking for? Yes, the market is looking for liquidity, right? It's looking for supply. If the price reacts strongly from POC, it can disrupt rule number 1. And finally, if time volume build at the edge of balance, price is likely to push through, right? So That is one of our favorite accumulation schematics, right? So, and also distribution schematics. So you'll be like this, right? And then all of a sudden, you'll have a last V with a platform, right? You're unwilling to rotate back to the bottom of value. And what happens? You get that V bottom with a platform and you break above, right? Same thing on the bear side. So what do we call this, guys? Does the platform use Deepak? I use VPOC. I don't know what Deepak is. Is that a dynamic point of control? No, I mean point of control is always developing. You only know Tupac. What do you mean by revert to the other side in the first bullet point? Rotate between value area high and value area low. That's the meaning of that. So there's 5 known catalog locations. I literally did a Google search, an image search, and copied this because time is not ample in my life at the moment. But type 1 is when you rotate into a prior value area, you try to V out, and you're trapped by sellers finding fair value at value area high, and then you rotate the full value area. The second is a full balanced D-shaped profile here, where you're within the value area. The third is our favorite short entry, right? It's when you traverse into value area, and you go from value area high to value area low, and then fail to peak above value area low and rotate lower, right? That is always a killer short setup. One of my favorites. And by the way, why would this occur? Why would we traverse the whole value area and then fail to transact above value area low? What's happening in this scenario? What would be happening in this scenario? It's a polarity shift of sorts, but why is it polarity shifting? That's correct. Right. There's no price acceptance, right? There's no price acceptance, right? Buyers or sellers are no longer willing to transact. Okay. Say this was that $800 iPhone, okay, and it turns out we get a shipment of 30 million iPhones, okay. Is the iPhone maybe going to fail to transact above $800 now? Maybe go down to 600, right? That is that particular price action dynamic. 4 is the entering of the prior value area and rejection of point of control. That's one of my favorite setups when you have a break a value area high and then a 2-wave corrective with a falling wedge snapback, right? We trade this every week in the room at least a few times. It's a phenomenal type of dynamic. And finally, here's your traversal of the value area without symmetrical rotation between value area high and value area low. And what does this typically signify, guys? What does that typically tell us? What does that typically tell us? Okay. Consolidation to go lower. The importance here is why. Why? A breakdown is coming for sure. Is it indecision? These people are pretty decided on what they want to do. Absorption. There is absorption happening here. But in terms of the auction, okay, what's actually happening? Why are we failing? The key word in all auction market theory is rotation, right? Why are we failing to rotate? Right. Not enough buyers are finding fair value at value area low, okay, enough to rotate price back to seller fair value, right, or top of value or value area high, right? Make sense? This is a Kenny ledge, right? That's what a Kenny ledge is when you come in and buyers are just unable or unwilling, okay, to give you a symmetrical rotation to top of value. And then what happens? Well, what happens is it rolls over and dies, right? So those are the five primary transactional modes of the value area rotation. And just a conclusion here. So AMT brings a logical explanation behind market movements and can be used with profiles, but also naked price action. We are barely scratching the surface here into auction market theory. We're not economists or theoreticians, right? We're here to make money and make fun of Lance. Those are the two stated goals, at least in my trading plan. So that obviously is not going to present. You've done it now, Aaron. I'm watching you. So that is really what we're going to be focusing on. But these concepts are essential, guys, to understanding what actually moves price. Okay, and we need to have a language with which to describe these phenomena. Okay. Let me move this up a little bit. Sorry. Why is that cut off? That's weird. Shouldn't be cut off. Anyways, introduction to volume profile. Volume profile is an advanced charting study that displays trading activity over a specified time period and in a specified price levels. If you're in this room and you're not asleep every day, sorry guys, let me turn that off. I apologize. If you're not asleep every day, you will notice a whole lot of horizontal squiggly lines on my charts that denote the volume profile. The study, accounting for user-defined parameters such as number of rows and time periods, plots a histogram on the chart meant to reveal dominant and or significant price levels based on volume. Essentially, volume profile takes the total volume traded at a specific price level during the specified time period, right? Volume at price, and divides the total volume into either buy volume or sell volume, and then makes the information and then makes the information easily visible to the trader. So that's all that there's to it. You guys have seen this. Out of curiosity, just from let's say 1 to 5, how comfortable are you guys with volume profile today? 1 to 5, just out of curiosity. No judgments whatsoever. We have 5s, we have 1s, we have 3s, we have 2s. Okay, so I'm glad I'm doing this because some people I know, a lot of you guys really use it every day. I know Lance went on a full crusade on the volume profile for the last 2 years, right, Lance? You've been hacking at it, and some of you guys are new to it. So, yeah, it's a great tool for sure. So, this in case you've been asleep in a cave in Afghanistan during market hours, this is what the volume profile looks like, right? So, typical levels of significance, and we're going to blaze through this, and then we're going to get into the nitty gritty. Okay. Point of control, the price level for the time period with the highest traded volume. Okay, so this is your highest transacted volume in D-shaped profiles. Of course, that's going to be usually the center of the Gaussian distribution curve, right? The center of the capital D, right? Makes sense. And in P-shaped profiles, it'll be at the top of the P, top of the flag, lowercase b, etc. So I think it's pretty self-explanatory. So profile high, right? The highest reach price level during the specified time period. Profile low is the lowest reach price level during the specified period. It is not the same as value area high or low, right? Value area high is the highest price level within the value area, and value area low is the lowest price level within the value area, right? So within the distribution curve, it is the highest and lowest, but it's not necessarily the highest pivot. Okay, as you all know, you can have pivot highs outside value area high and low, where price ran out of gas and rotated right back into the distribution curve. The value area, of course, is the range of price levels in which a specified percentage of all volume was traded during the time period. Typically, people still set it to 68.5 or 70%. That's a trader discretion. Okay, and so these are the primary levels of significance that we talk about. Okay, so here, for example, second. Support and resistance levels, used to identifying basic support and resistance levels. It is important to note that using volume profile as an identifier for support and resistance level is a reactive method, right? Remember, reactive versus initiative, okay? This means that unlike proactive methods such as trend lines and moving averages, which are based on current price action analysis to predict future price movements, reactive methods only rely on price past movements and volume behavior. The volume profile, reactive methods can be useful in applying the meaning and significance to price levels where the market has already visited. Why is that true? Why is it true that reactive methods can be useful in applying the meaning or significance of price levels where the market was visited? Well, how is that important? What do you guys think? The market has memory, but it has a memory of what, Ash? Well, I would say that the thing it has a memory of is behavior, price behavior at those levels, right? Is it correct to place interpret value area as 70% of the same as above? Yes, that's why a lot of people use 68 or 68.5. Jeff, yes, exactly. I think I use 68.5. Basic technical analysis has shown that a support level is a price level which will support a price on its way down, and resistance level is a price which will resist price on its way up. Because it's not practical, Jeff. A 2 standard deviation value area would completely annul any usefulness of this tool. So you're looking at support and demand and resistance levels, which are not always the same as demand and supply levels, right? What's the difference between a demand level and a support level? Anybody? All demand levels are support levels. All support levels are not demand zones, right? What is the difference? Anybody? Speed of action. Let me ask you a question. If you go to a zone where sellers are no longer interested in transacting, okay? Sellers, say you're in an uptrend, you're in the recumulative zone. Is it fair to say that some sellers may not feel like getting their junk kicked in by trying to short a potential reaccumulative zone? So could we say that there's low interest of sellers in transacting here because it's a bad risk to reward? What if you run out of sellers at a certain area? What will happen to the imbalanced nature of price? it will tend to rotate up through the value area, right? Could a resistance area be resistance and not an overhead supply zone because buyers are like, I don't know that I feel like paying $800 for CrowdStrike right now. I'll buy it at 420. So I'm gonna chill here and not buy it. Does that mean there's a whole lot of overhead supply here? Or does it just mean that there's lack of buyer interest? Right? Oftentimes, right, you'll be in a 10 weeks you'll be in a 10 week range, right, at all-time highs, and you'll break above all-time highs, right? And sometimes you'll break above all-time highs, you'll flag and liquidate and come and retest that prior value area, right? Rotate to a full value area rotation. Is that because you have a tremendous amount of overhead supply at all-time highs? Is that even possible to have a lot of overhead supply at all-time highs? 9, right? But you do have resistance, okay? Say, you transact 2 million shares in this flag and you come back and you rotate and then you come back here and you absorb most of that, very minor overhead supply and can't get above it. Okay, that's not an issue of overhead supply. Okay, it's that you do not have a sufficient imbalance in terms of perceived value to take the market higher. So demand and supply are not completely interchangeable with support and resistance. And these are really important concepts, guys. I know it seems nitpicky right now, but there are many cases, okay, where we're top of value and we're seeing things not necessarily able to move higher, and it's not because there are sellers there. Okay. Okay, so therefore, one can conclude that a price level. How did an hour go by? Jesus, pardon my French. Therefore, one can conclude that a price level near the bottom of the profile, which heavily favors the buy side in terms of volume, is a good indication of a support level. John K says, is it accurate that demand and supply rely on previously proven activity of that price? No, that is not true. It is not always true. What else could influence demand? Yes, fundamental catalysts. Okay, if you're told that we're not going to get shipments of iPhones for another year, okay, you know what? Price is going to skyrocket higher. Okay, and anytime you come close to that prior price, you're going to have a huge amount of demand for it, and it has perhaps nothing to do with a prior price, right? So fundamental information, catalysts, etc. Orange guy. All these exogenous variables can affect supply and demand just as much, right? I'm sure we can think of a thousand examples of that, but does that make sense, John? Right? These things, just like we talked about how we imbalances can be both technical and fundamental, so can supply and demand, right? Like think COVID, for example. You know what I mean? So yeah, no, that's a great question. All right, so high volume nodes in the profile. All right. Are peaks in volume at or around price levels? High volume nodes can be seen as an indicator of period of consolidation. Right, a high volume node is just a node within the price scale that's heavily transacted. And we're going to go over this graphically in a second. Which is more concerning, lack of demand or previous overhead supply, or it really doesn't matter? They're two different kinds of problems that have really different outcomes, Todd. Overhead supply requires getting through overhead supply requires what, guys? Well, there's one key term: absorption. Lance has been doing his homework. He read the new he read the new Dalton book and called me out on it. He said, "JR, Dalton doesn't believe in initial balance anymore." Huh? What about that? What do you have to say for yourself? I'm like, I don't care. That was funny. I was impressed that you read his new book, Lance. You get a cookie. Yeah, you had a neener moment there. So I kid. Lance is a very successful trader, longtime professional. He's my favorite Jew in Florida, and he knows what he's talking about. So I just like to rip him. So high volume nodes indicator of period of consolidation. Usually there's a great deal of activity on both the buy and sell side, and the market stays at that price level for a great deal of time compared to other levels in the profile. What's an example of one of our terms that we use for high volume node? I like to use a very colorful term, right? Have you guys ever heard me say monkey knife fight? Okay. A monkey knife fight is when you have a tremendous amount of interest in a level. Why are sellers and buyers actively transacting at that level? When you get a high volume node, okay, why are buyers and sellers both building value, meaning transacting heavily at that level? Why is that? They disagree. Points of disagreement end very badly for one side or the other, right? When we see high volume nodes, we see we see three things, or I see three things. I see support, I see resistance, okay, and more important of all, okay, I see price breaking in one direction or the other pretty violently, right? Think of your H setup. What happens when we build a very high volume node at the bottom of an H setup? What tends to happen, guys? Say we have a downtrend, a spike, a rounding top, and an H, right? And the volume profile is this big fat B here, okay? So this is the pattern, and this is the profile, okay? And you build this fat point of control right here at the bottom of the H. And buyers like, this thing's going to bounce, give me a W. I'm going to buy here. I'm going to add here. I'm going to buy my mama a condo right here, right? And the seller's like, listen, we're going to eat the longs for lunch. We're going to short here. We're going to add here. We're going to add some more here. And then we're going to get the measure move lower. Okay. There is commitment by both sides, aka monkey knife fight, right? And that tremendous amount of value that's built is building what? What would Wyckoff essentially, what would he call what's happening here? Right. He's building a cause. You see how all these terms are starting to come together? All right. Big Al, when he had too many drinks, used to call Wyckoff and Dalton one biatch, many faces. Anyways, I got to pay a little homage to my old mentor. So this can imply a fair value area for an asset. When price approaches a prior or previous high volume node or fair value area, a sustained period of sideways movement is sometimes expected. The market is less likely to immediately break through that price. What happens when it breaks immediately through it? What happens? Say you have a nice flag, okay? Your P-shaped profile is brought to you by Cialis, okay? And you have a liquidation break and a V that immediately breaks through a giant, super thick point of control, high volume node. What happens? It rips, right? It's basically the same concept as which of my favorite setups has this concept in it, where you're trapping all these shorts below fair value and then ripping it higher. Well, it's essentially the spring, but I was thinking a tricky dick here, right? So, you always have to think when you're going through these slides, what happens if the opposite of the expected behavior occurs, okay? Because what we call the opposite of the expected behavior, I like to call a good time. You know what I mean? AKA the breakdown. Please don't watch and call me. How is it 12 o'clock already? Jeez. All right. Good. Next. So here you have, you've probably seen this a gazillion times, right? And we're literally going to talk about, I call this specific setup a double whammy. When you have a double top into a high volume node, okay, monkey knife fight. What are shorts doing here? What are the bears doing right here? What are the bears doing? Are they covering or are they going, hey, I got a great deal for you. Listen, I'm going to sell you some Apple at 80.05. It's going to go to the moon. Don't worry about it. It's going to be great, right? No, the bears are looking for this two-wave corrective lower, maybe 50% retracement. Have you seen Banana split into double tops? She's like a panther, okay? Why? Why do shorts? Why are shorts interested in trying to fade a double top into a high volume node? Most breakout fail. Yes, most breakouts fail for sure. And what has been created here? What has been created here? Memory, and more importantly, supply. All these people, okay, are trapped theoretically into this move. And what are these trap traders most likely to do when they get back to the 80 handle? Yeah, so your sellers are going to see this as fair value for a sale, okay, and your pesky buyers, okay, are going to see this as an opportunity to catch leg two, okay? That's what creates the almighty monkey knife fight, okay? AKA high volume node. All right, so very important concept. I always tell you guys, in order to become really successful in the markets, we have to remember that we're trading against other people, okay? And we have to understand what the people opposite of our trade are thinking. We have to understand what game is being played here. And in the case of the double whammy, okay, shorts are seeing fair value, okay, and longs are looking at a reaccumulation zone. JR, is it fair to say it really could have gone either way, or just depends on who lasts longer? Dearest Ash, write this down. All right. I'm going to take the Copenhagen out of my mouth for a second. So this is clear as mud. All right. It can always, at any period of time, from the hours of 9:30 to 4 p.m., go either way. Always. We don't know. Okay. All right. That's what creates a market. That's what creates imbalance, right? Imbalance is created essentially by disagreement. Okay. So it can always go either way. Okay. Well, this is the great fallacy most novice traders adhere to, is that technical analysis is really is a predictive science. It is not. What technical analysis can give you is a picture of supply and demand. and help you understand the battle being waged. It cannot be predictive. Okay. Now, based on our experience and understanding technical analysis, we make predictive decisions based on odds and historical background. Okay. But technical analysis, even in and of itself, is never predictive. And treating it that way is one of the main things that destroys traders, in my opinion. So onto the low volume nodes. They're the opposite. They're the valleys or significant drops in volume in or around that level. So what creates a low volume node, guys? Why do we have low volume nodes in the market? No interest. Imbalance. Correct. Imbalance and no interest. Okay. I wouldn't say agreement, Jack. Well, there are in some cases it could be agreement, meaning no one's interested in transacting at that level, and that is a point of agreement. And in that case, it's certainly true. So low volume nodes are usually a result of a breakout rally or a breakdown. During a rally or a breakdown, there will be typically an initial burst of volume and then a significant drop-off. The drop-off can imply an unfair value area for the asset, meaning an area where people are just not interested in transacting. Why? Let me ask you guys another question. What could be another reason for low transactional volume in a certain area? What do you mean by depletion? I think you got it, Ash. Right. Lack of supply. Okay. If you're going through an area and there's not enough supply to fulfill the auction and bring it back to balance, what is price going to do? Right. So we're going to go through lots of examples of this today. Okay. So, say you had, April 9th, right? You had a big old ugly giant, beer gut of a transactional high volume node here, because people thought the market was going to go lower. Everyone was freaking out. They're like, Trump is going to kill us all, right? And then we rallied like 270 points higher. There was not enough supply to absorb this move. What were market makers doing? Were they lifting their offers? If people lift their offers, is there going to be any supply on the way up? You're just going to skip, 54.30, 54.50, 54.60, 50. You're just going to skip a lot of those levels because offers are being lifted. Okay, so when you see those drop-offs, okay, in low volume nodes, and I call them vacuums. It's because oftentimes it's not that there isn't transactional interest. It's that there's no supply, right? Why would you sell if you're a short or you're a seller and you see price going higher? Why would you sell your position at 54.50 when you think it's going to 57.30, right? You raise your offer. Exactly. All right, so that's a really important concept to keep in mind. All right, so a drop-off can imply an unfair value area for the asset. When price approaches a previous LVN, an unfair value area, the market is much more likely to rally through or bounce off that level. Why would we bounce off of a low volume node? Because now we're getting two really different type of concepts, right? So we say we have a high volume node, right? We start low here, we build a reversal wedge, and then we explode, and then we build a high volume node here, okay? And we start slow, right? We have a little reversal wedge, maybe it's a gap down from the prior day, and then we start ripping higher, filling the gap, and when we're about to get to that closing pivot, we build a giant new point of control here. Okay, so we go from a lower lowercase b-shaped profile to an uppercase b-shaped profile, okay, why would a volume gap beneath it act as an area of support? Lack of interest. That's correct, Duncan. Okay, so you can't analyze high and low volume nodes monolithically. Okay, they can be either an area of support or an area that you cross through like a hot knife through butter, depending on the context you're in. Does this make sense, guys? Okay. If it doesn't, let me know. Okay. Perfect. Perfecto. Okay. So here's a graphical example, right? We have a little rising wedgie here into a high volume node. We pop, okay. We come back. We hold the area pretty much. We slice right through this low volume node. We come back. We fill that gap. Hold point of control, and then have a two-wave corrective higher. Okay. When the market approaches the low volume nodes, it is common for it to break right through the area. In this case, right, what happens? The gap holds, right? There's no transactional interest in filling this gap. That is your gap and go there in a nutshell. Okay, perfect. So now we're going to go through a quick introduction to the anchored VWAP. Okay. This gets more exciting, guys. All right. I just need to. We have a lot of novice traders in the room. A lot of people with who haven't been trading with us for so long, and so I need to cover some of these basic concepts before we start going chart crazy. Okay. We're gonna go through about 100 chart slides today, and then for the section on footprints, there's another 90 to 110 chart slides plus footprints. It'll be about 270 slides on part 2. Okay, so there's going to be a lot. So don't get that chart anxiety on me, all right? So anchored VWAP in a nutshell. So traditional VWAP calculations always start with the first bar of the day and end in the final bar of the day. In some situations, the chartist would prefer to analyze the VWAP line based on a less arbitrary starting point and be able to extend VWAP line beyond the end of the trading day. Why would that be necessary? Why would you want to extend your VWAP beyond the end of the day? Why is that important? What does anchored VWAP provide? Let me go through the next paragraph. The anchored VWAP indicator ties VWAP calculations to a specific price bar chosen by the trader. Like traditional VWAP, it incorporates price and volume in a weighted average that can be used to identify areas of support and resistance on the chart. What does it tell you when you're in a bullish price action sequence, okay, and you anchor the first igniting move of that sequence? What will the return to that anchor from a day or a week or a month ago tell you? It'll indicate. So intrinsically, it'll indicate fair value, but what are buyers actually looking for technically? Fair value is technically correct, but what is it? What does anchored VWAP actually tell you based on where it's actually tied? 3 words. Underwater or over. Yes, so Lance is correct. In terms of dollar cost averaging, okay, is the average buyer at this price underwater or not? Okay. If they're over, if they're in the black, okay, let the buying continue. So it's a fantastic indicator of strength and trend. Okay. And a lot of people use anchored VWAP with moving averages, with CCI, the Commodity Channel Index, with ADX, whatever other indicators you like to use. So Anchored VWAP allows you to specify a price bar where calculations begin, making it easy to see whether the bulls or bears have been in charge since a very specific point in time. The starting price bar that is chosen generally marks a shift in market psychology, such as a significant high or low, earnings news, and other announcements. Anchored VWAP line is charted using price and volume data that from that significant event onward. Okay, so this is an example of the cues. Okay, you are in a uptrend here. You have a minor distribution, a C pivot here, okay, and a two-wave corrective back to the third point in the trend line, okay, and then you have a high volume. You have a high volume breakout that breaks out of the structure. Okay, I really like to combine structural breakouts with anchored VWAP, so I can anchor that point in time that really broke out of a specific structure. Okay, and you can see here, anchored VWAP gets you back in play on the next day for the two-wave corrective piercing reversal. Okay, and it keeps you out when it gets violated, right? You have your inverse and your head and shoulders here, your neckline break, and it keeps you out of trouble there. And here's your upper VWAP band. Okay, on the following day, you can take part once you VWAP squeeze and you take up this prior pivot. You can have a little scalp here. Okay, you have another little scalp here, and so on and so forth. Okay, it's a very, very popular strategy, popularized by Mr. Shannon himself, although it's actually not created by him at all. But he's been the primary evangelist. Really nice guy. So here's just a quick example of momentum breakout continuation strategy. The only reason we're going through this through this one particularly is to just, for the people who aren't familiar with anchored VWAP, to just provide an example, and then we're going to move on to the rules of volume profile. I have 21 rules that I use for volume profile, and we're going to go through each of them one by one, and then we're going to get into the charts. Okay, not 99. I got 99 problems, but if VWAP ain't one, I don't know what we want me to say. All right, so momentum breakout continuous. So we have trade compression structures within a sequence. All trades must be above pivot low and prior to anchored VWAP. All trades must open at or above price structure point of control. So just a random, it's not random. It's a good strategy, okay? But I'm just providing this as an example. All it enhances volume. The volume gaps, order imbalances, short sale restrictions, options flow, tape and order flow, key price levels, and moving average compression. All right, so supporting structures, right? We're looking typically phase D of the price cycle. That's this is where I live. I live here and here primarily. Okay, as a trader, some of you guys like to freaking bottom fish and top fish and do all that weird stuff. It's personally not for me, but it is what it is. So here's our old lady of chaos, Lady Tesla, Saint Tesla, and she's uptrending here into a minor distribution top. Okay, so we have a beautiful little wedgie here and a symmetrical triangle with two gorgeous opening range drives here and here for the people. So that's really, really nice. Okay, so we're just going to overlay the anchors here and the volume profile. So what do you call it when you have a accumulation structure and then the following day a point of control above the prior point of control? What do we call that? Anybody? Am I going to have to call on Lance, the entire class, children? It's these are stacked points of control. Okay. So you have your accumulation here. Now, by the way, what does this profile tell us in terms of this being a cumulative low? What does this profile tell us right here about this being an accumulative low? What is this telling us? What is it saying? Visits fields of Abaz. Yeah, no sellers near the bottom. Okay, we have a P-shaped profile. Okay, now later we're going to talk about the P-shaped profile squeeze rule that I have for the retracement itself. But what we can see here, okay, is that we have a nice P-shaped profile, very little transactional volume at the bottom, and what else is bullish about this particular profile in terms of the location of point of control relative to value area high? No interest below. That's true. What else is interesting about this? Yes, that's correct, Igor. Your point of control is right near the top. What does that mean in terms of how the day ended, what the dynamic of price was? Asymmetry up. Buyers are in control. They're buying the close aggressively, right? Is that typically a good indicator of a particular strategy a bunch of you degenerates like to take? Showing, yeah, overnights, right? No, you have a climactic, selling climax, right? Especially into a selling climax, right? Little transactional volume. You have a V bottom and a platform here, and you build a tremendous amount of transactional value here, and your point of control is right next to the top of value. Very, very bullish. It's indicative that you may in fact have bottomed and may be gapping higher. Okay, excellent. Now, what happened the next day? We had a two-wave corrective to what? This is 3 days, right? 1, 2, and 3. The move got faded. Two-wave corrective to what though? Where did we bounce? We went above it. We went right to the top of value. The next day we opened above below the accumulative point of control. And what did price action do immediately? What did it immediately do? With great ferocity. Yeah, exactly. Rejected. What do we call when we reject the prior days or prior accumulative point of control? When we reject it and move higher, it's a rotation, right? It's a failed auction into a rotation, right? Very important concept, okay? Because now the market will, the Eye of Sauron from The Hobbit and The Lord of the Rings, okay? There's a giant Eye of Sauron on this level, okay? This level becomes incredibly significant, okay? And so we have another two-wave corrective, okay? And value area low holds perfectly on day 3, okay? What structure is building here? More or less. You guys see what I'm saying? Okay. This is reaccumulative with compression, right? Is it fair to say that day 4 is one that you maybe want to be involved in to the long side? Why? Why do you want to be involved to the long side on day 4? What has happened? 1, we've rejected the accumulative point of control, right? This was a selling climax, right? People tried to smash Tesla to bits here. I don't even have price. It doesn't even matter in this analysis. Okay. We had a selling climax, a shakeout with very, very little volume. Okay. Same idea as the spring. Okay. Point of control, new value area high. We got overextended, two-wave corrective, value area high held. Then they tried to gap Tesla lower, point of control held. And are these higher lows? Yeah. So what do these higher lows tell us in relation to the auction? Okay. This is a rotation lower. This This is a rotation higher, a rotation lower. Okay, what does this price action relative to this market profile telling us? When you have lower highs and higher lows, what are you generating here? The beginning of an uptrend, right? What is that? What is that? It's a cause for sure, and you're generating compression. What does that compression ultimately generate, guys? Remember when we shake the champagne bottle? It's generating an imbalance, the pressure of an imbalance. At some point, okay, you failed these lows, no buyer interest. You shook out point of control, okay, and you have higher lows here. There are no sellers beneath this level, and then there's no sellers beneath this level into a very tight reaccumulative compression. Are we in an uptrend here? Is it fair to say that we're in an uptrend from this accumulative consolidation? Yeah, okay. So the context structure roadmap is bullish, right? So into this day here, day 4, okay, what do we see immediately happen? This is it fair to say that this candle is kind of making a statement here? It opens underneath this point of control and rockets higher. And what do these candles do? By the way, every single example in these slides are trades we have taken. Okay. No Monday morning quarterbacking allowed. It's honestly, Lance, if you're gonna be Mr. Murphy about it, it's a symmetrical triangle. I don't care ultimately, but if you're gonna draw this correctly, this is a symmetrical triangle. Technically speaking, if you're gonna plot the highs and the lows, it's a symmetrical triangle. The only thing I care about is that we're making higher lows, and that we're destroying point of control with a Marubozu right at the open here, and then we're holding above value area high. That's the only thing that matters to me. Whether I call it a wedge or a symmetrical triangle is of, in this case, no importance. I saw the same thing in Tesla yesterday. I saw compression sell rack, and I saw the overhead supply zone getting ready to be absolutely devoured, which is why I told you guys, I am into my second trade. I was already at 5 times my risk. It was an incredibly high conviction trade for this reason, for this exact reason. Okay. Yeah, that I mean, I thought I was pretty clear in terms of my conviction yesterday. Nadia's response is SOS. I don't know what that means. Are you in peril? Should we send the paramedics, Nadia? I'm not sure what that means. Are you guys using 0DT options to capture those? No, I'm not. That's all right. Anyway, so let's get on to the next slide here, because at this rate we're going to be here up till 7 o'clock. So here's a symmetrical. You can see I drew a symmetrical triangle, Lance, not a wedgie. Okay, and you can see here how scant this profile was up here, right? And we saw immediately it's not a full P, but it's pretty close. Okay. And, what did we see here? I think this is like day 7. What did we see again? The future may not repeat itself, as Samuel Clemens used to say, but it sure as hell rhymes, right? So open below point of control, and massive high volume surge past the value area, right? So we have accumulation, reaccumulation, markup, reaccumulation, and markup, right? And properly mapping that volume profile gives us a really good idea of what failed to happen. What failed to happen is more important here, or as important as what did actually happen, right? Were people perhaps seeing Tesla open underneath point of control thinking, we're going to rotate back to value area low? Were people seeing this also as a rotation back to value area low here? I think a lot of people were, right? And what actually happened? Well, a massive imbalance, right? That took Tesla through value area high and into an opening drive, okay? This is a perfect picture of imbalance. Have a question about your time frame. I see it's 15 minutes, but it's also 5 day, 5. I don't understand. Are you a TOS user? 5 day, 15 minutes. That sounds like a Thinkorswim question. Okay, it's a 15-minute chart. That the whether it's 5 or 10 or I could fit 30 days in here if I wanted to. That's not really relevant in this case. You know what I mean, bro? It's not a. Anyways, so we're getting to the view up. I promise. Okay. So the view up. So there's an anchored view up here at the pivot lows. Okay. If you had believed in this, if you had believed in the reaccumulative nature of this range here, and had said to yourself, well, self, as long as Tesla is over its pivot low anchored VWAP and over the cumulative value area high, it's a buy. Would you have been able to catch a nice trade here, even though the cause hadn't been fully built? I'd say so. Would you have been able to catch a nice 6-7 point scalp here? Absolutely, right? And here's the big kahuna. You're opening here on this day under a point of control, bouncing off the 15-minute 21 above anchored VWAP, okay? And here is your stars aligned trade, okay? And here's your other stars aligned trade. All right, so this is a perfect example of how anchored VWAP can really, really give you a very good idea of where you stand relative to the trend and the general dollar cost average. So now we're going to add an upper anchor, okay? And this is the Brian Shannon VWAP anchor squeeze, right? So when you have the cumulative or climactic pivot low and the first leg, this is your A pivot high. When you squeeze through this, oops, I didn't need to do that. Okay, that is when you get your maximum punching power there up higher. Okay, how can you get anchored VWAP? It's an indicator. Can't find it on TOS. Willie, I don't use TOS, but there are hundreds of people in the room that can, and you should ask some of your colleagues. Okay, I'm not sure, but I know that there's probably every possible variation of anchored VWAP you could possibly imagine, devise, or think about in Thinkorswim. If there's one thing they have is too many indicators, so I'm sure that it's available. I was playing with it the other day because I use Schwab for one of my swing trade accounts, and I went into Thinkorswim. I was just playing around, and the list of indicators, they're alphabetized A through Z, and each letter of the alphabet's got a zillion indicators. I was like, oh my god, these people are a bunch of freaking nerds. It was insane. So anyways, this is a really nice picture of what anchored VWAP can do for you. So once you're trending higher above your first reaccumulative structure here, look at the beautiful confluence you get. So you have the top of value area high, right? Gives you a beautiful polarity shift here. Right? You're bouncing off value area high. And once you're back in your value area, a beautiful mean regression trade right back to these prior highs, right? Same thing here, V platform, right off the VWAP. So VWAP is a great visual indicator for making sure that you're on the right side of the trend. Okay, we're doing this today just to make sure that people who are not familiar with this indicator have a good sense of it. So now So typically on anchored VWAPs as we progress, right? So as we have so you have an A, a B, and a C pivot, right? And then a breakaway gap. On the next segment, right? On the next segment, I like to anchor the next anchored VWAP as a pivot high. And then you can see here, you had a perfect confluence on this day 7 breakout. I think 7, right? Whatever this day is right here, where that day where you open underneath point of control, you were caught not only by your 15-minute 21, which is a fantastic trending indicator, but also your pivot high anchored VWAP, right? What did this tell us? Well, it told us that even for those people who had it here, right, you're still dollar cost average positive. So a really, really fantastic indicator. Very much so, vet trader. And I don't usually recommend a lot of things, but Brian Shannon's Anchored VWAP book goes through all this stuff in detail. I'm not like an Anchored VWAP evangelist, but it is an important part of my indicator repertoire. So if you're interested, I would recommend that you read it. Okay. You just like trend lines, anchored VWAPs need to be updated, or they'll stop being relevant. You know what I mean? Anyways, so let's keep going here. So, so just some key concepts to wrap up here before we get into the volume profile. So, volume at price on price scale instead of time scale. Key concept on high volume moves. Value area high, value area low will act as support and resistance. If you trade heavily outside value area, it will shift where value area shifts. High volume nodes act as magnets. If price is bullish, volume nodes will be bullish support, and vice versa. Okay. Oh, thank you, Monica. Again, I'm not making like a commercial endorsement or anything. Like I'm not associated with this guy. I'm just saying, if you're interested in learning more about the indicator, that is a good resource to get started. Also, Cooling's volume price analysis is, if you like profiling, is a phenomenal book as well. Okay. So does high volume node or point of control match you up? Another fantastic confluence. When I see that, I usually take action. Difference between hindsight analysis and real time on value area high and value area low. Okay, so VWAP is very much a real time analysis, whereas value area high and value area low develop throughout the day, right? You have to keep track of how those nodes fill out throughout the day. Okay. All right. So the shapes, the P, the B, the other B, and the D. All right, here we go. So before we get into Chewbacca's 21 rules of volume profile, okay, we're going to talk a little bit about the profiles themselves. There are some basic guidelines, okay, that like you should be aware of, okay. Oh, there's a free version. Look at you, Wilson Chase. Wilson, the tape chaser. All right, okay. So I'm just gonna draw here on the white part of my chart. A bio break. We're into an hour and 45 minutes. Do people want to take 5 minutes here? Do we want to take 5 minutes? Okay. All right. We're going to break for 5 minutes. Monica, do you want me to pause the recording real quick? Okay. I guess I can't pause it, but I can stop it, right? Okay. All right. Okay, guys. We'll be back in 5.